Early-stage venture capital faces a new threat: reverse acqui-hires. Big tech now bypasses startup acquisitions, directly hiring founders and engineers, while leaving companies and investors with worthless equity. This eliminates the traditional acqui-hire safety net, fundamentally rewriting investment risk profiles. Hyper exemplifies these risks. The DeepMind-founded AI video startup raised $13.8 million from Octopus Ventures in 2024, trying to position the company as Europe's answer to Runway and Sora. Despite solving hard technical challenges, it became a case study in frontier AI vulnerabilities when hyperscalers can step in with reverse acqui-hires. Dangers for talent-dominant companies. Key personnel poaching destroys value overnight, eliminates investor returns, breaks exit strategies, and creates retention crises, making businesses extremely vulnerable to direct recruitment. When Hyper emerged from stealth in 2024, it immediately captured attention as Europe's most credible challenger in the AI video race. Founded by DeepMind alumni Yishu Miao and Ziyu Wang, the startup raised a $13.8 million seed round led by Octopus Ventures, an early vote of confidence that suggested Hyper wasn't just another AI experiment. Early demos turned heads by tackling notoriously difficult challenges in video generation, and for a moment, it looked like Europe had found its answer to Runway and OpenAI's Sora. For venture capitalists, Hyper embodied both the enormous upside of frontier AI and the looming risks that arise when hyperscalers with unmatched resources can simply hire away the very talent that makes these startups valuable. Hyper's founding team blended academic prestige with consumer tech know-how, drawing from their time at DeepMind, Oxford, and TikTok. Their mission was to move past one-off clips and build video generation technology capable of creating coherent, professional quality output. Early prototypes stood out because they solved temporal stability, a problem that had crippled other generative video systems, where frames would flicker and lose continuity. Their timing was impeccable. Platforms like TikTok, YouTube Shorts, and Instagram Reels were shaping culture and commanding billions of daily views. That global hunger for scalable, high-quality video creation tools gave Hyper a clear opening. Very quickly, it was being described as a European leader in AI video, one of the few startups that could plausibly stand toe-to-toe with US competitors in this space. For seed investors, Hyper was a compelling opportunity. The founders themselves were the strongest selling point, combining research pedigree and practical experience. Technically, the company's early advantage in video coherence made it stand out from the noise of generative AI hype. Market upside was obvious. Video wasn't just a trend, it was dominating digital attention. The thesis was straightforward: build traction with consumers first, then scale into enterprise applications like advertising, media, and marketing automation. But even in the early days, investors knew the risks. Training and deploying video models required enormous compute. Scaling would be capital intensive, and there was always the threat that hyperscalers might bypass the startup entirely and pull the talent directly into their orbit. That possibility loomed like a shadow over even the most optimistic scenarios. By late 2024, Hyper had launched a consumer-facing app that was gaining traction among creators, marking a significant milestone for credibility. The brand was becoming recognized across Europe, differentiating it from many smaller AI projects. Behind the scenes, the team made steady improvements in model stability and video quality, showing they could continue to advance technically. For Series A investors, this was a classic scale-up play: fund larger model runs, expand infrastructure, and push into enterprise adoption. But the warning signs were hard to miss. Compute costs were spiraling without cloud credits, and the company was still heavily dependent on just a few individuals. Most concerning, the potential exit path was unclear. Would Hyper mature into a large independent player, or would it be stripped for talent before it had the chance? In early 2025, the fears investors had whispered about became reality. Microsoft hired both of Hyper's co-founders and several senior engineers. This wasn't a traditional acquisition with a payout to investors. It was a reverse acqui-hire. The people moved, but the company was never bought. By February, Hyper's consumer app was shut down, cutting off any chance of user-driven momentum. By June, DeepMind acquired the video generation model and absorbed some of the remaining staff. In just a few months, a company once hailed as Europe's AI video champion was dismantled. For investors, the outcome was brutal. Instead of liquidity, they were left holding equity in a hollow shell, stripped of its most valuable resource, the team. Looking back, seed and Series A investors weren't wrong. The market potential was clear. Short-form video was dominating digital culture. The product had traction with creators and showed real promise. The founders were world-class, with pedigrees that gave them global credibility. By any traditional venture measure, this was the kind of asymmetric bet that makes sense in a portfolio. Yet Hyper's collapse revealed something new. Hyperscaler gravity can overwhelm even the strongest investment logic. The key risk wasn't bad execution or weak markets, but talent absorption. When big tech decides it wants the people, traditional venture safeguards don't apply. That realization changes how investors must think about early-stage AI altogether. The Hyper story leaves behind critical lessons for venture capital. Reverse Acqui-Hires must now be treated as a baseline risk in AI, not an exception. Deal structures need stronger founder protections with clauses tied to departures. Investors should also push startups into enterprise contracts earlier, because consumer traction alone won't provide stability. Talent concentration is another big vulnerability. Startups need deeper benches, not just a handful of star founders. And perhaps most importantly, investors must broaden how they model exits. The old IPO or acquisition binary doesn't hold anymore. Reverse acqui-hires and partial asset sales are real outcomes, and portfolios have to be built with those in mind. Hyper wasn't a bad investment. It was rational, but collided with 2025 AI venture dynamics. The DeepMind alumni startup raised $13.8 million, solved hard technical problems, yet exemplifies how hyperscaler talent absorption has become the silent killer of early-stage VC. Investors can execute perfect due diligence, but when Microsoft or Meta offers fat packages to top talent, cap tables become worthless overnight. Frontier AI remains worth backing. The upside is enormous, but the risk calculus has fundamentally changed. Seed and Series A investors must adapt, structure protective deals, diversify talent risk, push enterprise adoption earlier, and accept reverse acqui-hires as landscape reality. Traditional acqui-hires offered soft landings for startups and investors. Reverse acqui-hires are trapdoors wiping out equity overnight, while founders get optimal outcomes and big tech wins talent wars cheaply. For early-stage venture capital survival, adaptation is essential. New deal structures, talent concentration awareness, faster enterprise traction, and novel tools like VC risk swaps protecting downside when teams get absorbed. In 2025, the most dangerous aspect of backing brilliant AI teams isn't execution risk. It's whether they'll remain independent or end up in Redmond or Mountain View, leaving funds holding empty equity. If the game changes, winning strategies must evolve accordingly.